Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. Welcome to Charts of the Week for May 10th of 2021. Please see our disclaimer for important information. In our COVID update for the week, on the left-hand side is our traditional COVID tracker. You continue to see the positive trends developing in daily new 7-day moving average positives and daily new 7-day moving average of deaths as well, continuing that positive trend. On the right-hand side is kind of a cumulative figure for doses that are going to be available in the market. And so basically by the end of this month, May, we should have enough volume to be able to inoculate the entire population if we wanted to. And certainly by June, we know that there have been about 250 million doses administered, and that includes about 8 million to 9 million of the Johnson & Johnson one-shot vaccine, about 240 million of the combined Pfizer, BioNTech, and Moderna therapies. And so simple math tells you then that's probably about at least 120 million people that have been inoculated, which is about a third of the population. And if you look at Texas in isolation, which is not necessarily one of the leading states in terms of getting its population inoculated, we're sitting about 37 to 40% in that range right now. But clearly we're going to have enough volume here in a very short period of time to cover the entire base of those who are going to want the shot. Now, on the other hand, while we've seen a lot of positive developments across the world, including some vaccination catch-up, if you will, in Europe, India remains, no pun intended, but a hot mess. You can see this huge spike. And in fact, this is a humanitarian crisis of sorts in India right now. And the side note of all of this is that India, from a shipping and transportation and global trade standpoint, does have an impact. And there's a meaningful, I want to say perhaps maybe 20% of shipping, could be impacted by this very thing right here. So while we're dealing with supply chain constraints and choke points and shipping and things like that, which we'll talk about in a few minutes, this certainly isn't helping. It could extend the timeline by which we kind of recover those supply chain constraints. Here's our high frequency data from First Trust. Again, most of this data is positive. There's a little bit of noise in the data. Don't worry too much about the supply of motor gasoline. That'll pick up during the summer. We do know that commercial flights, we've been tracking all of these in isolation for many, many months. We know flights are kind of picking up a little bit. They're trying to max out the inventory that's in the system before the industry begins to add more flights and supply. But we do see more TSA checkpoint data by and large, hotel occupancy. There's more mobility going on, and then more from a retail and industrial standpoint. Rail car traffic is still very positive. We did have a setback in the labor data. We were expecting to have perhaps 1 million jobs in the latest jobs report, and we fell far short of that data point. And there's some kind of interesting implications for the stock market on that, which we can talk about in a second. But by and large, the high frequency data is still very positive. Just one anecdote on this. The energy market, which is really kind of taking it on the chin, kind of recovered somewhat. We have had a fairly strong recovery in energy prices. You can see here that crude oil days of supply going back down. We had the disruptions related to our winter storm a few months ago. Those appear to have kind of worked themselves out. We're kind of back to a more normalized downward trending line, getting back to normal. Now, as we get into some of the economic data and eventually into market-related data, this is something I wanted to start off with that I felt like put us on a positive light. Clearly, we've had a a really strong spike in household net worth. That's in that dotted red line. Now, the personal consumption line follows that fairly strongly. So, we've had a rebound in personal consumption. We know this, we've been following the data, and that correlation between household net worth, again, consumers are confident, stock market's going up. Again, that could reverse. We could have a little bit more volatility in the market, and I think we probably will, but the bias is still going to be for the market to continue moving higher. But as you see here, that consumption, which represents 2/3 of the total economy, it's very important that this number continue to act in a positive way, and I think it will by and large throughout the remainder of 2021. Some employment data on the left-hand side is the total initial claims. This is what gets reported every week. You can see that the trend lines are moving down. We're having less of the pandemic unemployment claims in that light shaded blue. We know that total initial claims are moving down. That's very good. On the right-hand side is continuing claims for unemployment. We do see a greater distribution accounted for in those pandemic emergency numbers, and the regular benefits continue to go down. So this is what has become a bit of a political football, as a lot of the states are doing better, they're reopening, the data is looking better, the national data is looking better, and a lot of states are trying to move to end some of these unique benefits that are being paid out that in some respects is keeping labor on the sidelines, because people are making more from their benefits, unemployment benefits, that they would be in a job, and it's creating supply of labor choke points in the market. So it'll be interesting to watch this continuing claims number as we get deeper into the summer months. And speaking of the labor market, here is some favorable trend lines. Now, we know manufacturing job openings have continued to move higher. Manufacturing has done extremely well. Durable goods orders and shipments have done extremely well. So we knew that line was moving higher right off of the trough in the pandemic. But what was less clear was what was going to happen with the retail numbers and hospitality, tourism, those most impacted areas during the pandemic. Well, in a positive light here in 2021, as we've seen more mobility, as we've seen more high frequency data points move in a positive manner, that these numbers are really starting to look good. In fact, if you date back from February 1st, which is actually before, at that point there was, I believe, one case in Washington, perhaps, and this is still by and large a Chinese phenomenon on February 1st of last year. But if you index everything to that date, I mean, you can clearly see that even on a retail standpoint, that we're above where we were in terms of job openings a year ago, and we're getting there in hospitality and tourism, and we've already been there in manufacturing, production, construction. Very positive trends here as of late. Now we'll talk about employment on ISM services. Now, these are two things that kind of relate to the cost of employment. And so this is an input into final prices. It's an input into company margins, and clearly what's being evidenced in this left-hand side is that the Employment Services Purchasing Manager Index is moving higher. The cost of labor is increasing. On the right-hand side, what you have in the blue line is the unit labor cost, and as we just said, those are clearly moving higher. And then you can see the relationship between, the year-over-year change in both the core personal consumption expenditures index as well as the core CPI. And so, there is a relationship here. It's not an extraordinarily tight relationship, but it is positive. And the one takeaway from this is that we've seen such a strong move in unit labor cost just as of late. And the labor number here in this chart is pushed ahead. It's basically it's 3 quarters ahead of where this other data is on this timeline. And so the implication here is that you're going to have an inflation pickup that's going to dovetail with that rise in unit labor costs. It seems logical. It certainly seems empirical that with unit labor costs moving higher, that you're going to have more inflation down the road. Now, if you look at ISM Services Prices Index now and match that against the core personal consumption expenditures, you can see that those are moving higher. Now, PCE, personal consumption expenditures, is what the Fed looks at. This is the bogey that they've been monitoring to try to keep pace with their dual mandate of full employment and stable prices. And so, their 2% target, if you look right here, the ISM Services Price Index, which is on the left-hand margin there, it's moving higher, but on that left axis, you can see the core PCE year over year is still below that 2% number, and that's apt to move higher if services prices continue to move higher. And we know that manufacturing prices are moving higher. On the right-hand side of this chart, you've got the Citigroup Inflation Surprise Index, and not too surprisingly, I guess I should say, that those numbers are moving higher. We've had more surprises on the inflation side lately than we've had in a long, long time, and they seem to be consistent. They seem to be lining up. We've already seen, we just talked about employee cost index, employment cost index moving higher. We know that input prices are going up, copper prices, steel, lumber, commodities are moving higher. We've got a chart on that coming up. So the Citigroup Inflation Surprise Index continues to move higher. So if we look at commodities, you can see, we just talked about this, the Bloomberg Commodity Spot Index on the left-hand side is moving higher. And you can see in a relative term, or on a relative basis, going back to 2011, both of these charts are saying the same thing. On the right-hand side is the Reuters Jeffries Commodity Index. And so they track different things. The magnitude of the increase on the Bloomberg Commodity Spot Index, which spends a lot more, has a much higher weight in some of the hard commodities per se than the Reuters and Jeffries Index does, but they're moving in the same direction. You can see on the Jeffries on the right-hand side that line that kind of sets that sets the kind of the peak, the interim peak of what we've seen in commodity inflation by their metric, dating back to 2016. We're hitting that resistance point right now. And then on the left-hand side, the Bloomberg Commodity Spot Index, we haven't seen that level of that index since 2011. Now, here's something that is going to help our GDP is moving forward. Now, we talked a little bit about inflation. Let's talk about the sustainability of the economy. And we've had lots of enthusiasm as of late. We know that we're going to get a really good economic growth year here in 2021. And I think this is one input into it. When you think about inventories and investment, customer inventories are at a historic low right now. It has a lot to do with a lot of things. We've had supply chain constraints. We've had port blockages. We've had semiconductors that have been in short supply. We've talked about that before. And there's so much of what is produced now that has some semiconductor component to it that this is causing inventories to be low and the backlog of orders, which is on the right-hand side, to be extraordinarily high. So there's a lot of pent-up demand here, and inventories being low. Inventories is oftentimes kind of an interesting fulcrum point for GDP and for economic growth. And oftentimes and we have had recessions that have been born out of having a glut of inventory. And then, obviously, if you have a glut, then you don't need to produce as much. And that has historically been a catalyst point for sending a good economy into recession. However, now this is exactly the opposite. And if anything, even though we've already had a strong economic response from the pandemic, this sets the stage for a fairly strong and continued growth rate. Now, looking at prices paid. Now, we know that producers are paying more for the input costs. And if you look at that on the left-hand side, that number looks a lot like some of the charts that we've already talked about. Again, price inputs are going higher. On the right-hand side, if you dovetail that and overlay that with CPI, Consumer Price Index inflation. This is CPI is what gets reported every month, and it includes food and energy, which can be a little volatile. And you can see here that there's a reasonably positive relationship. And so, with input prices that producers are having to pay, or moving higher, that just lends itself to more inflation down the road. So with all of this inflation input and observation of inflation risk here, you can see that there's been a lot of interest in TIPS, which is a Treasury inflation protected security. So you can see the ETF, the price of the ETF, money flows into inflation protection really ramping up high. And you could also see from the swap rates on 5-year dollar-based inflation swaps are now moving close to about 3%. This is just another proxy for what 5-year expected inflation could look like. Now, I wouldn't get too worried that we're going to have 3% inflation over the next 5 years. It's just telling you right now that this 5-year inflation swap, that the risk is increasing, and so the risk is being priced into these securities. So this is one thing that I wanted to make sure that I said. Now, I've been pretty emphatic about inflation migration and the fact that inflation is moving higher. But then, a lot of the inflation numbers that are being reported right now have base effect impacts, meaning that inflation was really low last year during the heart of the pandemic. And so naturally, if you have a little bit of inflation this year, that represents a large percentage increase over a year ago. And so these base effects will reverse next year. And so this is underlying a large part of the argument behind we're going to have the spike in inflation this year, and then next year we're going to have less inflation, but perhaps more inflation than we've been seeing. And I would agree with this point. And so this illustration from Guggenheim Investments, I think, tells a story that, that they're even going so far as to say that inflation may revert back to where it was, a year and a half ago. And I'm not so sure that that is the case, but directionally, I think their point is valid in the sense that we're going to have an inflation spike that's going to hit a plateau when then some of these supply chain choke points work themselves out, and we get back to a more normalized supply-demand balance in terms of shipments and orders, that you could still see higher inflation, maybe not just what we're anticipating here over the next 6 months. Here's something else that I think is worth considering too. So productivity is kind of like the kryptonite for inflation, if you will. So the more productivity you have, the better you're able to hold inflation at bay. And so you can see that the bias over many, many years has been up. So you have many more observations on a monthly and quarterly basis of positive productivity than you do of negative productivity. And I won't go into the definition of how productivity is calculated. It's a little bit esoteric, but by and large, we've had some fairly decent productivity, and we had a really good data point represented in red here of almost 6%. And this, if it continues, will help to keep that inflation component at bay, over the next 12 to 18 months. Now let's talk about the market for a little bit. So here's, I'll start off with this chart. It's just basically our trailing 12-month price to earnings ratio with the long-term average overlaid. So long-term average we know is about 16 times. Here it's depicted as 16.3 times. That would be, price over earnings, price divided by earnings. Right now it's about 22 times. Now it has been higher. It did spike before we had the recovery, and it remained higher. But interestingly enough, with prices and the market moving and the index values continuing to move higher, we've had such a strong response in earnings, which we'll talk about in a second, that the multiple in the market has actually gone down. And this is a kind of a unique phenomenon. And I think it does help to explain that coupled with the fact that interest rates are still pretty low, even though they move higher, but rates have actually kind of tempered and kind of moved a little bit lower than they were at their interim peak, that it gives more sustaining power to market growth. And I could continue to see, based on some of the estimates, which we'll talk about, that earnings are moving higher, much higher than anybody would have anticipated entering 2021, that multiple could actually drop even more and make the market on a relative basis even that much more attractive. I'm going to spend a couple minutes here talking about the relative valuation of the equity market versus the bond market. And here we've got some information from Bloomberg. On the top hand side of this is what they call the stock to bond ratio. And this is basically taking the S&P 500 returns divided by the 10-year Treasury total returns. And what this indicates to you is very clearly that equities are pricing in a very strong economic boom, which we're in the process of witnessing right now. So you can see that in the composite valuation index below, which according to Bloomberg's calculation here is basically an average of price to earnings, forward price to earnings, price to cash flow, and price to book on a standardized basis. So it's taking into account a lot of different measures, and you can see the valuations, even though they've moved higher, it still represent a fairly strong optimistic outlook, if you will, and discounting a major economic move. Looking at our market in a slightly different light, I wanted to evaluate and see kind of what the expectations were for the market based on the fact that we've had such a strong move last year. We were up about 75% from the very trough of the market, which was on March 23rd of last year. And if you go back, and there are 10 other instances where we've had really strong 250-day percentage gains. And what happened to the market in that period of time? And if you look like 65 days henceforth from that 250-day marking point, it did a little mixed. I mean, the market was basically flat. It was positive only about 60% of the time. If you go 125 days, then that slips a little bit. So here's where the volatility kicks in. You had more instances dating back on these 10 other instances where you had strong 250-day price movements that the market was down about 60% of the time, positive only 40% of the time. However, if you went another 250 days, there was a 90% probability of the market being positive, with average gains in that time frame being about 12%. So maybe this is all, suffice it to say that a lot of the heavy lifting, the heavy gains have been made, but if you're patient and you don't get hung up in the volatility, that there are more gains to be had. And even though the market valuations are higher, we've shown that they have come down from their peaks. Earnings growth is really strong. We have a really strong economic backdrop. We have vaccinations, opening economies, better performance, better hiring, better labor market, that there's a lot of kind of mother's milk, so to speak, that's out there to help keep this economy growing, which is going to help keep earnings growing, which if you can put up with some interim volatility, which might be evidenced by the 60 to 125 day range, that when you get past that and you look longer term, you're in really good shape. I'm excited to show this chart. This is a plot of the S&P 500 overall index, which is in blue, against the S&P 500 equal weighted index. And that's just basically taking the value of each company, each constituent company within the index, and then putting an equal, basically 1/500 weight to it. Now, we know that the S&P 500 index that you read about in the newspapers and you see being reported is what they call a capitalization weighted index. So the largest companies in the index, like say Apple, for instance, has a really outsized weight. So There's a lot of companies in the S&P 500 index that have basically de minimis weight in the index. But if you equally weight them, what this chart shows you is that the performance of those equal weighted stocks is actually better than the overall index, which is dominated by these large capitalization stocks. So this tells me that the returns in the market that we've been seeing are representative of more market breadth, which is very healthy. We want to see all boats rising, not just a few, which is what we had last summer. We had a lot of companies that were falling by the wayside, that were underperforming, that were actually going down at the same time that we have these large 5 technology stocks moving astronomically higher and carrying the index higher. Well, that's not the case anymore. It's exactly the opposite. We have very good market breadth. And so looking at this chart, I'm very encouraged that we have greater participation across the index. And we'll take a quick look here at US versus the world. Now, I do think the international diversification is very important, very relevant. In the right-hand chart, you have a valuation, basically comparison of the MSCI index for the US, which is in red, versus the MSCI index for all countries across the world, excepting or extracting out the US, so ex-US. You can see that the valuations, and these are trailing valuation numbers. The US, obviously, this number has come down a little bit since this survey was taken, but you can clearly see that the US is much higher valuation than international markets. On the left-hand side, you can clearly see where the US has outperformed, particularly this year. This is basically a year-to-date performance chart, and while returns were kind of equal, if you will, through March, they've really begun to expand out as we've had a little bit more clarity on the reopening and this economic growth, and in particular this optimism coming out of earnings season. But there's still a wide gap, and that gap is actually getting wider. So this is why I think this is the 2 charts that would help me make the case for international diversification, because the international markets are clearly not as expensive right now. Something else I've been talking about for a long time that I'm really excited about is the fact that we've got companies paying dividends again. We had a lot of companies, as you can see here, just as we did back in 2009, that were either ceased paying a dividend or cut their dividend paying rates, and we saw how the balance sheets of corporations were really strong last year. And they were being defensive in the pandemic because there was a lot of known unknowns at this time last year. And the big hope and the expectation was that, 1, they're going to begin to spend more money on CapEx, which we are seeing. 2, that we are seeing those companies either resume paying their dividends, and in a lot of cases increasing their dividend rates, especially because earnings are increasing. And we've got a couple of charts on that, but this is a really good data point that this is getting more money back into the hands of shareholders, increasing shareholder return. If you go back over the last, essentially the last 30 to 40 years, the numbers are pretty clear that, more or less about 40% of the return in the market is due to dividends. So we like to see this chart play out. So here we've got net margin. So this is a byproduct of what happened with all these earnings releases, that we're really kind of on the tail end of first quarter earnings season. Margins are moving higher, profitability is moving higher, free cash flow is moving higher on the part of S&P 500 companies. This is allowing them to pay those increased dividends. This is allowing them to make more capital investments and generate better shareholder returns. This is something that requires a little bit of explanation here, but on the left-hand side, we've got the 4 quarters of 2021. On the right-hand side, we've got 2021 and 2022. Now, the blue lines represent what the expected earnings growth rate was at the end of March, basically at the end of the first quarter. So this is before earnings season, and you can see the first quarter was expected to be, earnings were expected to be up 21%, 52% in the second quarter, up 19 and 15 respectively in the last two quarters, and up 24% for the year. And even next year, looking ahead, maybe 15%. Well, since we've been through earnings season now, we've seen a lot more near-term optimism. So, what's playing out here in the first quarter, looking back in the rearview mirror of all the earnings that have been reported, is that the earnings growth rate is actually about 35%. And so second quarter is being revised higher to 57 versus 52%, and then revised higher for the last two quarters of the year. So we're drawing forward some of that future expected growth. And so as a result, the 2021 year, if you will, earnings are expected to be up 30% versus 24%, which is the prevailing wisdom, a little bit more than a month ago. Now, that's borrowing a little bit from future periods, so that 2022 number is just slightly lower, but it's still positive. And if you assume that you have, basically, if you have no, valuation change, the price to earnings ratio doesn't change at all, and all you have to do to, all you have to drive, drive growth in the index is earnings, then you're already looking at 30% growth in the index this year and 13% growth in the index next year. But we know that these things work in tandem. But I think it's really uplifting to see, even if you have a 30% and maybe even a 10% next year, that's still very positive, and it provides a lot of tailwind towards this market moving higher. And it goes directly to that point of where you've got the earnings that are moving higher than your prices are in the index. And I'm not going to sit here and say that I think that we're going to see a 30% move in the index from here. But I do think that we're going to see a really strong earnings year, and that's going to cause that price to earnings multiple to continue to go down, and on a relative basis, not look as expensive as it has. On this slide, I wanted to highlight the relationship between the manufacturing index and the stock market. And I've mentioned before that the manufacturing part of our economy has gone down over the years. Obviously more things are being produced elsewhere than they are here in the States, but manufacturing is still very important to the stock market, to the economy, to sentiment, etc. On the right-hand side, you see the Institute for Supply Management, or ISM Manufacturing Index. The last data point was a little bit lower than we were expecting, but still, this is what they call a diffusion index. So anything above 50 represents expansion. So anything, say, north of 60 represents really strong expansion, and that's where we are right now. Now, if you go to the left-hand side of this and you say, all right, well, what has the stock market done when we've had different levels of this ISM? So that blue line says that when the ISM is rising, we have tremendous S&P 500 price returns. And that's where we are right now. And that's where we have been for some time. Now, when the ISM falls or it's flat, and not even not even below 50, not even in contraction phase, but if it's stalling out, then the market still is positive, but it's not nearly as positive. It's not the returns aren't nearly as robust. You can see that in the red line. It's clear that from this chart that we want to continue, and I think there's a lot of staying power behind the manufacturing renaissance here, behind this manufacturing pickup. We see it in all the data, and I think there's staying power to that. And so with that, I do feel that with the caveat of there being likely some increased volatility on the horizon, there still is an upward bias in the market. Stock allocations among U.S. households. I thought this was really interesting. This is from a research piece out of J.P. Morgan. And if you go back to, this one goes all the way back to the post-World War II environment and shows you how U.S. household stock allocations have evolved over time. And we know that there's been a kind of a secular pickup, if you will, dating, really back to the mid to late 70s. And we've had spikes. Obviously, we had a lot of investors in dot-coms, which went, they had no business plans, no revenue, but the stocks went through the roof. And then we had a bubble bursting, and so that number went back down. And it's gyrated a little bit. Obviously, we have the global financial crisis, which kind of shocked the system. But you can see that household stock portfolios have continued to go up, and move exceptionally higher in this latest move. And I think that's very symptomatic of what we're seeing in the stock market today, which is more influence from small investors, more participation by the small investor, and more interest in the market by the small investor. This is a quick look at cryptocurrencies. I won't get into crypto very much, other than the fact that we have Dogecoin now, which is it's another one of these fad cryptocurrencies. My feelings as far as crypto haven't changed. There's a regulatory overlay that has to be developed over this before it can be anything but a speculative venture. But as you can see here, going back to really just several months, that it is there's been a tremendous amount of trading in crypto. Non-financial corporate debt. Continue to watch this, just because we're at levels of corporate debt that we have never seen, particularly in at least a generation, if not several generations. However, corporate balance sheets are in really good shape. We do watch this from the standpoint if earnings decline and the ability to cover interest goes down, but right now interest rates are very low and the cost of financing is really, really cheap right now. So I worry less about the aggregate levels of corporate debt as a percent of the total economy, but it is interesting to watch here. Food prices. This is another one of those baskets that we monitor with regard to inflation. This isn't the U.S. This is actually the United Nations World Food Price Index. And this is pretty profound when you think about, the fact that you've got a lot of areas where food constitutes an outsized percentage of a household budget. We're blessed here in the U.S. that food accounts for a fair amount, but maybe half to a third of the relative amount as it does in other countries. And you can see here with food prices going up, this would be one thing that I would watch with some reasonable amount of caution in terms of the sustainability of this synchronized global recovery, is that food prices are going up. So investment in structures is something that I'm also been monitoring, and this chart does a really good job of kind of explaining the difference in what's going on. So on the one hand, and the purple on the left-hand side, this is from basically the Federal Reserve of St. Louis, and they track this on a national basis. So investment in residential structures, we know home building, we're way behind. We're very low on inventory right now, and we're way behind on home single-family residential construction right now. That number is through the roof, but conversely, we see a drop-off in non-residential construction, which is offices, and it encompasses a lot of other things like industrial warehouses and retail, so on and so forth. But on the right-hand side, you can see where businesses are investing, and you can see that they're investing in software and technology. That number continues to go higher and will continue to go higher, accelerated by this whole notion that a large part of their workforce can now work from home or work remote. And they're putting less money into structures, or they're maybe keeping the amount of structures they have right now, but they're just not adding to it. And so on an aggregate basis, that investment is declining. I think these two charts represent a trend that is going to be well entrenched over the next several years. We're going to see a really high investment in residential structure and really lackluster investment in the non-res side. And in our final slide of the day, this is something that, with all the rhetoric out there, the trade wars, the supply chain problems that we had, the medical supply chain problems that we had in the pandemic of being able to source PPE and all that, there's been a lot of rhetoric wanting to draw more manufacturing back to the U.S. And this chart actually from Reshoring Now actually shows that that's happening. Now, it's not happening to the degree it was maybe a couple of years ago, as we were dealing with the kind of I guess the height of the trade and tariff wars, if you will. But it's picking back up again, and I think that this will be something that we're going to watch and continue to play out over the next 5 to 7 years. That'll do it for this week. On behalf of all of my colleagues at BKA Wealth, really appreciate you spending the time with us today. Hope you've enjoyed it. Please let us know if you have any questions, and I hope you have a safe week, productive week, and we'll see you again soon. Take care.